Most people think money is controlled by whatever they can see. They think the stock market controls wealth because the numbers are on television every day. They think banks control mortgages because the loan officer is the one sitting across from them. They think their employer controls their paycheck because that is the name printed at the top of the direct deposit. I have spent most of my life around capital, and I can tell you that those are surface-level stories. Underneath all of it, there is a quieter force that decides what your house costs, what your stocks are worth, how aggressive your employer can be, and how fragile your job becomes when the cycle turns. That force is the bond market. If you do not understand bonds, you do not understand the price of money. And if you do not understand the price of money, you are walking through modern life without understanding gravity. That is the mother line I want you to hold on to. The bond market is the gravity system of money. You cannot negotiate with gravity. You cannot motivate your way around it. You cannot post a clever opinion online and make it disappear. You can ignore it for a while, just like a man on a cliff can ignore the drop below him. But the moment you build your life on assumptions that fight gravity, gravity collects. When I was younger, one of the great advantages I had was not genius. It was respect for invisible forces. I cared less about stories and more about the structure underneath the stories. I wanted to know who really sets the terms, who writes the contract before everybody else starts arguing over the scraps. In finance, that contract is usually written in interest rates, and interest rates are disciplined, amplified, and transmitted through bonds. People hear the word bond and their eyes glaze over. That is a costly mistake. A stock can make you richer. A bond market can make an entire population poorer, more cautious, more indebted, less willing to buy, less willing to hire, and far more vulnerable than it was 12 months earlier. A stock can excite you. A bond market can reprice your whole life. So let me show you the system the way I would explain it if I wanted you to stop being a spectator in the economy and start seeing the machine that is operating behind the wall. A bond is not mysterious. A bond is an IOU with institutional consequences. If you lend someone money and they promise to pay you back later with interest, that promise is a bond in spirit, whether it is printed on beautiful paper or displayed on a screen in a trading system. Governments use them because governments spend more than they collect. Companies use them because growth is expensive and cash is never enough for ambitious people. Investors buy them because they want a claim on future payments. But the beginner's definition is not the important one. The important thing is this: once enough people agree on the return required to lend money safely, that number starts spreading through everything else. It spreads into mortgages, it spreads into auto loans, it spreads into corporate refinancing, it spreads into how much risk investors are willing to tolerate in stocks. It spreads into whether a weak company can stay alive for another year or whether it has to start laying off people to survive. That is why I call the bond market the gravity system of money. It is the field that everything else has to move inside. When I say gravity, I do not mean drama. I mean discipline. I mean there is a rate at which money can be borrowed without pain, a rate at which it starts to pinch, and a rate at which it begins to break things. Most people wait until something breaks and then ask what happened. I would rather understand the force before it gets a chance to crush me. The first mechanism inside this gravity system is what I call the deficit engine. A government is not a magical source of money. It collects money, promises money, spends, and when the promises exceed the collections, it has to borrow the difference. That borrowing is not academic. It is not a technical footnote. It is a constant stream of supply entering the market. If a government brings in trillions and spends more trillions than that, the gap does not fill itself with good intentions. The gap gets financed. New bonds are issued. New promises are sold. New future claims are created and distributed to investors, institutions, pension funds, banks, insurers, and foreign holders who are willing to park capital in exchange for a return. You should notice what that means. When the government borrows, it is not just funding itself. It is creating the baseline price for capital. That is the first reward point in the structure. The government's need becomes your benchmark. People want to think their personal finances are personal. They are not personal in the way they imagine. They are local expressions of a national pricing system. The next mechanism is the one that makes the entire system click. I call it the yield seesaw. This is where smart people can create a huge advantage for themselves simply by refusing to remain confused. A bond has a face value, a payment stream, and a maturity date. That sounds dry until you see what it implies. Suppose I own a bond that pays me $3 a year on a $100 claim. Then newer bonds come to market paying $4 on that same $100 claim. My old bond did not change its personality. It still pays $3. But relative to the new bond, mine became less attractive. So if I want to sell it, I probably have to accept a lower price. That is the seesaw. When price goes down, yield goes up. When price goes up, yield goes down. The payment looks fixed. The attractiveness moves. And because attractiveness moves, the market is constantly repricing the true return required to hold money in this form. That may sound like a small technical curiosity. It is not. This seesaw is the transmission line for the whole economy. The man buying his first house is not studying the bond market, but the bond market is studying him whether he likes it or not. The family trying to move into a better school district is not sitting there reading Treasury auctions, but Treasury yields are sitting inside the mortgage quote that bank hands them. The young investor chasing growth stocks is usually looking at price charts, product launches, and earnings stories. He should also be looking at what a safe bond is paying, because the safer return gets, the less patience the market has for fantasy. That is why I tell people that ignorance of bonds is not a knowledge gap. It is an exposure gap. You are exposed whether you understand it or not. The third mechanism is what I call the housing clamp. A great many people think banks decide mortgage rates out of pure discretion. That is not how it works. Banks borrow and lend inside a competitive financial ecosystem. They look at what they can earn on safer instruments, what funding costs them, how long they are tying up capital, and what premium they need for taking household credit risk over government risk. That means mortgages are downstream of bond yields. If the yield on a major government benchmark is low, the whole mortgage structure can relax. If that yield rises sharply, the mortgage structure tightens like a fist. Now watch what that does in real life. When mortgage rates are extraordinarily low, monthly payments stay manageable, even on higher home prices. Buyers crowd in, demand rises, sellers become confident, prices jump. People start thinking houses are supposed to rise like that forever. They confuse cheap money with permanent value. That is one of the most expensive psychological errors in finance. People mistake an environment for a truth, then the environment changes. If the bond market reprices and yields move much higher, mortgage rates follow. Suddenly the same house requires a radically different monthly payment. The buyer who could afford the payment at one rate can no longer afford it at another. Demand should weaken. Normally sellers would cut prices hard, but real life is never clean. If millions of homeowners are locked into old low rates, they resist selling, because selling means surrendering a cheap mortgage and replacing it with an expensive one. So supply freezes. Buyers step back. Sellers hold tight. Transactions fall. Affordability gets destroyed without the dramatic crash people were waiting for. That is the housing clamp. The bond market does not need to crush nominal prices immediately to punish people. It can simply make movement impossible. It can trap young families outside ownership. It can trap existing owners inside old houses. It can turn the housing market from a ladder into a traffic jam. And notice the arithmetic embedded in that mechanism. A small change in rates can create a gigantic change in lifetime cost, because housing is purchased through time, not with headlines. If the monthly burden rises by several, that is not a mood change. That is thousands every year, tens of thousands over the life of a loan, and an enormous shift in what kind of neighborhood, school district, commute, or family plan becomes feasible. That is what bond gravity feels like on the ground. The fourth mechanism is what I call the risk hurdle. Now we move from houses to stocks. I smile when people talk about the stock market as though it exists in a separate universe governed only by innovation, charisma, momentum, and hope. The stock market is never that independent. The stock market is always competing against the safe return available elsewhere. If I can earn almost nothing on a safe bond, then the appeal of stocks rises dramatically. I will tolerate more uncertainty because the opportunity cost of taking risk is low. I need growth, I need earnings, I need something that can outrun inflation and mediocrity. In a low-yield world, capital becomes adventurous. But if safe bonds start paying me a serious return, then the conversation changes. Now, every stock has a new burden. It must justify why I should endure its volatility, its disappointments, its management errors, its competition, its dilution, and its occasional collapse, when I could have taken a respectable return without that theater. That spread between what I can earn safely and what I hope to earn in riskier assets is one of the central hidden levers in markets. When the safe return is tiny, investors get generous. When the safe return rises, investors get demanding. That shift in demand is enough to reprice entire indexes. This is why long periods of low rates can produce extraordinary stock booms. Capital is being pushed out on the risk curve. It is searching for return because safety pays nothing. And this is why rising yields can suddenly make stock multiples look silly. The company may still be wonderful. The product may still be excellent. The narrative may still be exciting. But if the hurdle rate moved, the valuation framework moved with it. That is the risk hurdle. Bond gravity changes the level every risky asset must clear. A lot of investors lose money because they think in stories first and benchmarks second. I prefer the reverse order. I want to know what safety pays before I get seduced by aspiration. There is another piece here that matters psychologically. When money was essentially free, people got used to abundance. They began to behave as though capital would always forgive delay, losses, experimentation, and bloated plans. That is what cheap money does to the human mind. It reduces respect. It makes undisciplined behavior look visionary. Then yields rise, and all the hidden bad habits become visible at once. That is not just a market event, that is a character test. The fifth mechanism is the one employees usually notice only when it is too late. I call it the refinance blade. Many workers believe their salary is paid from revenue alone. Sometimes that is true. But in a great many businesses, especially growing businesses, payroll is supported directly or indirectly by borrowed money. Debt funded the expansion. Debt funded the extra locations. Debt funded the inventory build, the experiments, the software, the acquisitions, the hiring wave, and the illusion that scale could be purchased before profits had fully matured. As long as money remains cheap, this can continue for years. Management looks smart, headcount rises. Offices expand, employees start believing the environment is normal, then the old debt matures. Now the company has to refinance. That is when bond gravity stops being theoretical. A company that borrowed at 3% may discover that the next round of borrowing requires something dramatically higher. The interest burden doubles or worse. What used to be a manageable financing line now starts eating real cash. Management has only a few choices: raise prices, cut investment, sell assets, issue equity on ugly terms, or cut people. This is why layoffs often look sudden to employees, but not to anyone watching refinancing conditions. The problem did not appear on the day the layoffs were announced. The problem appeared when the price of money changed and the company's business model could no longer carry its debt gracefully. That is the refinance blade. When the blade swings, weak business structures lose fingers first and heads second. And notice how cruel the sequence can be. The same cheap money that encouraged overexpansion also trained workers to assume that growth was organic and permanent. Then expensive money arrives and reveals that a portion of the payroll was really a byproduct of easy credit. I do not say this to make you fearful. I say it because I want you to build your life with a better map than most people use. The average person studies products, personalities, and quarterly noise. I want you to study financial oxygen. Can this business breathe if debt becomes expensive? That is a much more intelligent question than whether the office looks busy. The sixth mechanism is what I call the spread alarm. Not all borrowers are equal. The safest borrower can usually borrow most cheaply. The weaker borrower has to offer more. That difference between the yield demanded on riskier debt and safer government debt tells you something important. It tells you how suspicious the market has become. When that gap widens, fear is increasing. Capital is becoming selective. Lenders want more compensation because they trust less. That widening is an alarm bell. It is the market's way of saying that safety is being repriced upward and weakness is being punished. You do not need an economics degree to use that information wisely. You simply need to understand what it means. It means liquidity is becoming less generous. It means fragile firms are entering a more dangerous zone. It means refinancing will hurt more. It means hiring plans may be too optimistic. It means the economy may be weaker than cheerful headlines suggest. And it means that if you are living too close to your financial edge, this is a terrible time to remain careless. Now I want to turn the lens toward identity because this is where the subject becomes valuable rather than merely interesting. Most people move through financial life with the identity of a rate taker. They take the mortgage rate the market gives them. They take the savings yield the bank offers them. They take the valuation regime the stock market is running on. They take the company culture and compensation structure as if those things emerged from nowhere. They react after the fact. They are passengers in a system that is pricing them every day. I want you to flip that identity. I want you to become a gravity reader. A gravity reader understands that the price of money is not background noise. It is a strategic signal. It tells you when to be aggressive and when to be patient. It tells you when leverage is a useful servant and when leverage becomes a loaded gun on the kitchen table. It tells you whether a house payment is a sensible long-term commitment or a beautiful trap. It tells you whether stocks are being offered with a generous risk premium or whether investors are pretending that risk has disappeared. It tells you whether your employer's expansion is grounded in durable cash flow or floating on temporary credit conditions. That identity shift matters because wealth does not only come from choosing good assets, it comes from refusing to make major commitments under stupid pricing conditions. People are always hunting for the next big winner. I have often made good money by first avoiding the next big mistake. The man who understands gravity does not need perfect prediction. He needs correct orientation. Now let me make this practical. If I were teaching a young person how to stop living at the mercy of bond gravity, I would not start with jargon. I would start with a protocol, not a philosophy, not a slogan. A protocol. The first part of the protocol is duration discipline. You must stop borrowing long when your finances are short. What do I mean by that? If you are one layoff away from panic, one unexpected repair away from debt, one medical event away from disorder, then you have no business building a life that depends on every rate, every paycheck, and every monthly obligation remaining friendly. Your first defense is liquidity. Cash is not exciting, but cash buys time. And time is what keeps gravity from turning a setback into a catastrophe. A person with no buffer is not making decisions. He is making emergency reactions. So before you chase return, build breathing room. That means an emergency reserve large enough that higher payments, a weaker labor market, or delayed opportunity do not immediately force you into expensive choices. The second part is mortgage humility. Do not buy your maximum approval. Banks lend on formulas. Wealth is built by margin. There is a huge difference between what you can technically finance and what you can comfortably carry if the world becomes less kind. If yields are high and affordability is ugly, there is no law that says you must participate right now. One of the great financial skills is the ability to remain unhurried in environments that are pressuring everyone else to stretch. Owning the wrong house at the wrong financing cost can turn ambition into indenture. I would rather buy later on strong footing than buy now on fragile footing and spend years pretending that strain is success. The third part is equity discipline. When safe bonds pay very little, equities deserve more attention because the alternative is weak. When safe bonds pay respectable returns, I become more demanding on price and quality. That does not mean I run from stocks. It means I insist on being paid properly for bearing uncertainty. Too many people buy stocks as though the bond market has no opinion. The bond market always has an opinion. The question is whether you are listening. The fourth part is job, risk awareness. Study your employer the way a lender would study a borrower. Does the business produce cash or consume cash? Did growth come from real customer economics or from cheap financing? How much debt has to be rolled in the next few years? How sensitive is the company to higher interest expense? What industry spreads are doing? How cyclical demand is? Most employees never ask these questions because they prefer emotional comfort over structural truth. That is understandable. It is also dangerous. A career is an asset. Treat it like one. The fifth part is laddered optionality. If yields rise enough, safe instruments become useful again for ordinary people. Not just institutions. There are periods when locking in sensible returns on a portion of your capital is rational, honorable, and deeply underrated. Not every dollar needs to audition for glory. Some dollars need to protect your future self from your current self's enthusiasm. A cash ladder, short-duration treasuries, or other low-risk vehicles can become more attractive when rates are meaningful. That optionality matters because it prevents you from becoming a forced seller of long-term assets at bad times. It is easier to think clearly when not every problem requires liquidation. The sixth part is psychological inversion. Whenever rates are low and easy money makes everyone feel clever, ask yourself what happens if the benchmark normalizes. Whenever rates are high and people act as though nothing good can survive, ask yourself what becomes attractive if the pressure eases. Inversion keeps you from becoming a prisoner of the current mood. It reminds you that cycles are powerful but not eternal. And it helps you avoid the dumbest habit in finance, which is confusing the present environment with permanent truth. Now, I want to go deeper on one point because it separates adults from children in capital markets. Most people do not lose because they lack information. They lose because they cannot emotionally tolerate being out of sync with the environment. When houses were surging, they felt stupid renting. When stocks were flying, they felt stupid holding cash. When rates were low, they felt stupid for being cautious. When rates rose, they felt stupid for having taken risk. This constant emotional imitation of the crowd is exhausting, expensive, and unnecessary. A gravity reader does not ask what feels fashionable. He asks what the price of money is requiring. That is a calmer question. It is also a more profitable one. The bond market humbles vanity because it reminds you that capital has a required return. You can talk about disruption, branding, narratives, dream homes, lifestyle upgrades, and aggressive expansion, fine. But in the end, the bill gets sent to mathematics. And mathematics is not sentimental. If your expected return over risk, free alternatives, is too thin, you are not investing with sufficient intelligence. If your housing payment consumes too much of your future flexibility, you are not buying shelter. You are selling freedom. If your company depends on refinancing miracles, you are not working in a stable enterprise. You are standing near a credit-sensitive accident. That is why I say bonds are not boring. They are brutally honest. They strip romance away from finance. They tell you what money costs when no one is trying to flatter you. And once you understand that, a lot of confusion disappears. You stop asking why the bank is being mean. You ask what benchmark the bank is looking at. You stop asking why your favorite stock suddenly derated. You ask whether the risk hurdle moved. You stop asking why layoffs arrived so fast. You ask how much of the prior expansion depended on cheap refinancing. You stop seeing life as a collection of isolated personal disappointments and start seeing it as a capital system transmitting pressure through different channels. That shift alone will make you more patient, less emotional, and better at staying out of traps. There is also a larger lesson here about sovereignty. The person who understands the price of money regains a degree of control, maybe not over the entire system, but certainly over how exposed he chooses to be. You cannot command rates. You cannot force the market to cooperate with your wishes, but you can decide how much debt to carry. You can decide how much buffer to maintain. You can decide whether to buy risk blindly or demand a margin. You can decide whether your life will be built for smooth conditions only or for the full weather cycle. That is real control, not prediction, preparation. People often ask me what the secret to long-term wealth really is. They expect a clever stock answer. Sometimes the better answer is structural resilience. The person who can survive bad pricing environments without panic acquires opportunities that the overextended person never gets to see. When credit tightens, cash becomes more valuable. When risk is repriced, discipline becomes an asset. When everyone else is being forced to react, the prepared person gets to choose. Choice is one of the highest forms of wealth, and the bond market, ironically, teaches that more clearly than most glamorous asset classes ever will, because it teaches you that the world is constantly setting terms. If you know the terms, you can adapt before the crowd. If you ignore the terms, you will call your suffering bad luck. Let me bring this all the way down to a simple test you can carry with you. Before you make a large financial commitment, ask 5 questions. What is the current price of money? How dependent is this decision on that price staying favorable? What happens if the benchmark moves against me? What am I being paid for the risk I am taking over safer alternatives? And if conditions get tighter, do I gain choices or lose them? Those 5 questions will save you from a remarkable amount of stupidity. Not all of it, but enough to matter. I have seen people spend years mastering stock tickers while remaining helpless in the face of mortgage resets, job risk cycles, and rate-driven repricing. That is like learning to admire the weather while refusing to understand climate. The bond market is climate. It is slow until it is sudden. It seems distant until it is everywhere. It looks boring until it rewrites the terms of your house, your portfolio, your employer, and your confidence at the same time. So here is the final choice. You can continue living as a rate taker, reacting to whatever gravity decides to do to you next. You can keep calling houses expensive, stocks confusing, layoffs random, and banks unfair, while never studying the field that ties all of those outcomes together. That is one path. On that path, you will keep mistaking symptoms for causes. You will keep making commitments without respect for the price of money. And when the cycle turns, you will pay with options, with stress, with delayed dreams, and sometimes with years you do not get back. Or you can make a different contract with your future self. You can decide that from now on you will read gravity before you leap. You will watch the price of money before you borrow it. You will measure risk against what safety is paying. You will care about refinancing exposure before you trust an employer's expansion story. You will build buffer before bravado. You will choose flexibility over appearance, math over mood, and resilience over financial theater. That path is less flashy. It is also the path that gives you the right to remain calm while other people are being whipped around by forces they never bothered to understand. In markets, calm is not just a feeling. It is purchasing power, it is staying power, it is bargaining power. And in a world where the bond market sets gravity for almost everything, staying power is one of the greatest advantages you can own. If you do not understand bonds, you do not understand money. And if you do understand bonds, you begin to see something most people never fully see. The economy is not a mystery. It is a pricing system. The sooner you learn to read the price of money, the sooner you stop being surprised by a world that has been signaling its intentions the whole time.